What is going on, my friends? I hope you are doing well today. The team at TRE wants to say thank you so much for all the support. Thank you for joining today. This is the Real Estate Podcast, and we want you guys to do us a solid. If you don't mind, can you help us get the message out? We believe that real estate can be for anybody, and we believe there's opportunities for people to grow with us. So if you can, please share, subscribe, like, comment. Thank you for being here on our journey, and we are going to continue to add as much value as we possibly can and try to shake up the industry. Let's dive in.
There's been more millionaires in this country made in real estate investing than anything else, period. You're watching the right guy. He's talking about the right subject. He's in a city that's booming, that I think continues to boom, and which is one of the reasons when I was down there, it's like I was down there for cannabis and speaking at South by Southwest. I'm like, Matt, can I meet with you? And you're the young Turks that are going to be the next generation of leaders.
All right, everybody, welcome to the Real Estate Podcast. I am very excited. One of my favorite people, a serious entrepreneur, Kyle, cannabis business, but also in real estate, and had a really great experience being an entrepreneur in real estate. Kyle, thanks for being here, man. Really honored to have you on the show today.
Hey, thank you for having me. You're one of my favorite shows. So how cool is this? And you talk about the two things that I spend most of my time thinking about: real estate and cannabis.
I love it. Same here, man. Well, yeah, so there's a lot going on in the world, and I thought this would be a really good time. You know, we've got this brokerage here in Austin. We've got 180 agents, and people are unsure. And you've been through this before. I'm trying to figure out on my end, how do I lead and inspire people while things are tough? You know, obviously it's time to get entrepreneurial. It's time to hustle and out hustle, but really want to dive in on this episode on the market, you know, how people should be thinking about it, how you approach it, kind of what you've learned, and just straight business, if that's all right with you.
Oh, let's talk real estate. I get a lot of my friends are hitting me up the same thing, because it's each time you go into a cycle like this, it's different, and so we have a lot of different things going on. So yeah, I'm looking forward to this conversation, and also learning some things from you as well, because Austin is one of my favorite markets, and you know it like no other.
Yeah, thank you. What would you say right now? Does this, you know, I know we're kind of early in this, but does it feel different? Does it seem different from other, you know, market downturns or periods of inflation? And maybe what are those differences that, you know, we need to be thinking about?
So let's first agree that we are in a real estate downturn. That I think it's unequivocal. It's different than the last. You know, you think about when things went off the rails in 2008. That was a credit crisis, and the black swan there was foolishness in the subprime market, and the lenders were just writing. It was bad, and it was completely different. And then the RTC days of the late 80s, early 90s, more 80s, late 80s in Texas, more early 90s out here in California. But those were different too. Again, really bad lending standards, a tax change under Reagan that it took a while for the teeth to bite. So here, this time we have inflation in the United States that we haven't seen since the 1970s. Now, I didn't play in that market. I was a kid. You didn't play in that market. You're younger than me. And so the Fed's response to it is what has changed the game, because, you know, let me ask you, you're right on top of it. I have an idea about where it is, but if I want to get a 30-year fixed rate right now on, let's talk income property, what am I looking at right now today?
7.5.
7.5, so 7.5. And let's say when I was down in Austin earlier this year, and you and I got together, what were the rates then? They were sort of near the low.
Yeah. For investment property at the time, be probably 4.3 when we met. You know, primary, you could get into threes.
Right. So let's say, and then at the low, I was able to refinance one of my fourplexes that the one I bought The last one I bought a few years ago, I think I'm at 2.875. I got lucky. I targeted it low, but I'm also watching like you. So basically, we're over 300 basis points or 3% higher from when you and I were sitting in Austin to today. So if you're an investor, to make the math easy, just from 30,000 feet, whether you're in California or whether you're in Texas, that's a whole other discussion about path of progress and population growth and all that kind of stuff. But so the unleveraged rate of return, or cap rate, so when you look at it, you would think that the cap rate would move in pretty close lockstep to the interest rate. So that means it would need to go 300 basis points. That's quite a shock to a seller, because if the rents have not moved up dramatically, that's the other way to keep your cap rate up in your price. And the rents, I don't think, have been that dramatic. Then we have an issue where you're going to buy something and have negative leverage, which means that your unleveraged rate of return, let's say, is a 4%, which means if you buy, just for the audience that may not know what a cap rate is, but let's say you buy something for $1 million, and you have no loan, so unleveraged, and you make $40,000 in profit after paying everything, and 40,000 divided by $1 million would be 4%. And then if you're borrowing at 7.5, that means that you will be negative. You'll be underwater. So that's a situation you don't want. You always want to have positive leverage, meaning if I'm buying at a 4 cap and making that 40,000, I'm borrowing at, say, 3%, and then I have 1% or 100 basis points of positive leverage. So the negative leverage is something that, as an investor, it's a really tough thing to do unless you realize that property has so much income potential that I can change it. So so right now the negative leverage is where we are. But I'll share some thoughts. I don't want to just keep talking, but I'll share some thoughts on where I think things go and where the opportunities will be for investors right now, and for your brokerage team right now, which is they're not enjoying this time.
Yeah, no, that's great, man. One thing that I've seen, I don't know if you see this, but now that there's a lot less buyers, and I never knew, because I'm 13 years in and I've always said, I want to see a downturn. And everyone's like, no, you don't. But I kind of did, in the sense that if you're going to be in business, you got to know how to operate within it. And I've never seen how this house is now 40% less desirable, 30 days later. And it's so real. But what we're seeing here in Austin is, now that there are a lot less people to buy, they're renting. Historically here, rents don't really go up that much. Like, we've got properties and we'll bounce them up $50 a month or $75 a month. Now we're seeing you can bump those things up $250, $300, because there's a lot more competition for people trying to rent. So that's one positive for owning assets. And I'm sure you would agree. I believe this to be true. No matter what's going on right now, you want to have assets, because they're going to stay above whatever the inflation rate is happening.
Yeah, I love your candor that, hey, I was hoping for the downturn, because things don't, I mean, we don't live in a secular environment. We live in a secular environment, right? So we've been due. But I will tell you, downturns suck.
Yeah.
And they suck for the different folks in the business, investors, brokers, at almost a little bit of different time. Like right now, I don't do any brokerage. I like working with people like you. I like, let the professionals do what professionals do. I'm still the, founder chairman of a large property management firm. So have my finger in the operations and my finger on the pulse because of that. And I own a lot of real estate. And so I'm sitting at a situation where I've been really picky, knowing how pricey things were. I can't verbally cheer for a downturn, because uh, man, people, they eat my butter. So, but I would say that the natural order of things would be to expect a downturn, start preparing for one when you've had a long period of growth, and we certainly did. Then we have to look at why did we have such a long period of growth, and I would tell you that we've been printing money.
Yeah.
And this is not a shot at Joe Biden. Every president since Nixon has basically printed more. I clicked at about 1 year. So fairness to him, he did that. But basically, each president is a new sailor that's more drunken. And Biden is the most drunken sailor you've had, and Trump was just before him. So, but as an investor, it's like, look, they're going to do the policy they do. People are going to vote for the policy they do. But as investors, we have to look and try and clear the noise, take away what we think is right, wrong, all that, because that only clouds your judgment. The more that you can just get to what do you think is likely to happen. Now, if it shapes what policy you want in the future, that's a whole separate discussion. But again, let's look at it. So with all the policies the Biden administration has been pushing, the anti-inflation, it's quite inflationary. And I don't think what I'm saying is controversial. I think almost every economist in the world will look at it and go, you just can't borrow more money. Yeah. Even if you plan to spend on this, that, you just do it to cause inflation. If you forgive student debt, that's money that the U.S. paid to on behalf of somebody else who was expecting to get it back. If you write it off, it's inflationary. That's just the reality of economics. So to your point, if I didn't bring my wallet, I was going to hold up $1, but if you hold up $1, you know, I remember when 20 felt like a lot of money. Now it's like that. Now feels like what 100 is.
Yeah.
Like and so then you go, okay, Kyle, what? I can't control that, but if I own a hard asset, like you're saying, your units and my units, it is a hedge against the inflation because, you know, ultimately, it's nice to have those investments and cash flow coming in because you're going to end up raising the rents to, you know, through that cycle. So, and it builds wealth, but it also preserves wealth. So right now, if you're a young person or you're any age and you don't have any assets, it's a really bad position to be in during this. This is going to be very punishing to people without assets. So I encourage everybody. 4 times a year, I get up and I speak to our entire property management company. It's almost like 500 team members. And this second time this year, my whole thing is about, even if you start saving a little bit of paycheck, start saving, get that chip, because that will then help you get, it'll help you get into the ball game, and you have to get into the ball game. And I'm not tone deaf. There are people out there working some very difficult jobs, not making a lot of money, just trying to support their family and just trying to get by. And I get that. But I would just say, if it's possible to start saving and having a separate account that you put money away, that's what I did. And I'll stop talking in just a second. But I remember when I started saving for my first purchase in 1991. I don't want to ask how old you were, Matt. I'm not even going to ask that because it'll upset me. But
I was just born.
God damn it. I knew I wasn't going to ask it. Damn it, Matt. You did it to me. But what I would tell you is people are like, you know, the best time to buy was the 70s and the 80s. And the reason is because it's already been written. It's in the history books.
Yeah.
And I thought to myself, and then my son who's 22 asked me, we're driving, he goes, Dad, is the American dream dead? And I said, from what I'm seeing at the southern border and what I'm seeing in our colleges, you know, with the foreign students coming, that'll look to be dead from their eyes. So, and I said, I guarantee you the people that don't believe it's dead now in 20 years are going to show you that it wasn't.
Yeah.
So believe in the opportunity. We live in the United States of America. This is where you can actually go make your dreams come true. It's not easy. It's hard. I know it. but you want to buy assets. I happen to favor real estate more than equities. And I highly recommend people buy that 3 and 4 unit building, and we can get into why that versus a 5 and a 6. But man, if you don't have it, thank goodness, I'm grateful that the younger Kyle sacrificed for this Kyle by buying units, by not going on vacation, by driving a 15-year-old Honda, by doing those kind of things. You can see I don't dress that nicely. I don't have a nice watch. I don't have like Nike SBs. I've just got some I order off the internet from that are ASICs because they're comfortable. So I'm much more about putting my money to work for me, and I encourage everybody to do that.
Yeah, no, I love it, man. I relate in a lot of ways.
Totally.
Me and my partner both drive Priuses, and I teach a college class, and he came in and was kind of laying everything out. And it was funny to me when he left. One of the students said, "Hey, can I ask you a question?" To my partner. They're like, "What kind of car do you drive?" You know, and he was asking that question because he assumed it was something very nice, and that's the only reason you'd ask that. And it was just fascinating. But we're all in on that. I love that you said, you know, you're not tone deaf, because the way I look at it is, yes, it's hard. You know, we're sitting here and we have a positive attitude about what we're gonna do, but what else are we going to do? We either complain or we go and attack the opportunity. That's all there is to it. So you might as well tell yourself, you know, that you're in a positive space and that there's opportunity out there. And the other cool thing that I really liked about working with you was you were kind of, I feel like you were prepared for this in a sense, at least when we were looking at deals here in Austin. You were very careful at the numbers and where things were, and knowing that things could change quickly. I remember that with you more than anybody that I've worked with. And then I would assume with your property management company, essentially that's designed, obviously to manage your own properties, but that's a perfect way to sustain a downturn, because the commissions will stop, but the rents and the management income will not. And I've always been all about that.
It's an annuity business.
Yeah.
If you will, you know, it continues. This is the hard part for my broker friends. And look, the only reason I'm wealthy today is because people like yourself. That's why I can't wait till we do our first deal. Like even if it's a small fourplex, I want to take you out to steak dinner after, you and your wife, and thank you, because it's brokers that are out there working, and you know, they don't get paid unless they close deals. And so that's when, if I decide to sell, I always go back to that broker. Like, even though I have a broker's license, or I could sell by owner, I never do that. It's my way of saying, you guys put me in a great position. And so you're right in that. And I like the team. Everybody that we worked with your team, Matt, was extremely professional, also very knowledgeable, which made it easier for us, because you guys are on the ground. You're seeing things real time. And, you know, we're out here in Los Angeles. So yeah, for people that are thinking about investing, having a relationship with you and your team is key. And be frank with you, I want the relationship with you partly just because, you know, I think that where I am in my career cycle, I could bring a lot of money to deals pretty quickly. But I think if I were a young investor, and I'm sure you cater to a lot of young investors, the younger Kyle would have wanted to meet you, periodically stay in touch with you, but I would have asked you to pair me with one of your team members that you thought fit me and what I was looking to buy. Yeah. Specialize that way. And then just, you know, if you had the time for a check-in periodically, that's all I would hope, was just to find out from you what you're seeing, but I'd be following your podcast. So
I love it.
And that's what I did. I mean, we didn't have podcasts and things back in the 90s, but you know, I still have some very long and good relationships with the brokers that give me the access to the market. But right now, here's the delta we have that's painful for my broker friends. Buyers move like this. When they see interest rates go up 100 basis points, they're expecting the cap rate to, you know, to go with it, to go up with it, right? So interest rates go up, cap rate goes up. Sellers are still living on what you told them it was worth when I was in Austin.
Yeah.
And they're like, no, it's still a great piece of property, even though they're sophisticated, they hold on to a value, and that creates this delta between what a buyer expectation and a seller expectation is. And what fixes that, and what will fix this, one of two things are going to happen. Interest rates are going to go right back down, and off we go. I don't see that happening for a bit. I do think they will end up going down, but not. I don't know when. Or people that are in divorce, people that have inherited property, so death, divorce, and partnership dissolutions, because those are real sellers. And I would tell my broker friends, you have to have the hard talk with the seller to say, this is what I can actually sell it for right now. And remember, a lot of buyers have gone to the sidelines, not even considering buying right now. But I think I could get them to come off the sideline if I can now put it back in the frame of mind that, okay, this is the return on investment you would have gotten 6 months ago. You can still get that return now, although with inflation where it is, people are a little bit more sensitive, wanting a better deal than that. But it's going to be those folks that reset the comps, because then it's like you're going to be able to show, and I'm sure it's already happening with death, divorce, and partnership dissolutions. But typically it just takes, it's like turning a ship. It just takes some time for that to happen. And for God's sake, we need inflation to get under control. And as we saw this morning, that didn't happen.
Right. Well, one strategy that I'm seeing really be a good option right now, you've got a 3% or 4% mortgage and you want to sell, just owner finance it. Do a 2 or 3 year balloon, give them a 6%, give them 5%, and get the same price. And then they'll pay it off in a couple of years. Like, that's really a good way to go about it. 2-part question for you. I don't know.
Very, very creative. That I like that a lot, because that's another way to do it. The difficulty is if they have debt on the property, you got to be careful of that, because if they see a change in ownership, they used to do some things out here called subject to, like you do this thing subject to the lender finding out. You just got to be careful of that. But there are owners also that don't have much debt, and if they only have 20% LTV debt, a down payment could just clean that up, and then you could certainly give a good loan. Matt's really creative. That could work.
Absolutely. So here's my 2-part question. I wonder if these are the same answers, but I'm trying to think, okay, put yourself in a position where you're, just getting started in your career, you're 18 years old, and you're dealing with this market, and also you dealing with this market right now. What are you doing in both? Maybe doing the same thing. I don't know, but does that make sense?
Yeah.
Like, you got no money and you got the money that you got now. So I guess it has to be different. Yeah.
So how about let's see, I bought my first house when I was 24. So let me put me at the 24. I would be living lean as I can. It's a habit that I highly recommend. I always want to end the year in the black, meaning that whatever I've made, let's say from my management company or for Glass House or wherever my job is, I want to make sure that I've lived within my means just from that alone, and that all my investment income I make goes back into new investment income. And I know that sounds crazy, because it's once you start making some more money, the temptations are to get the Ferrari, or I'm talking if you make some real money where you go, wow, okay, and to stay disciplined. And for me, it just depends on what is your life's motivation. I've always been building for the future, and that's what I recommend people do. And so the 24-year-old me, I was new to the business. I would be making my relationships, and I'd be learning an area near where I live, whether it's a C area, maybe a more working class area, more affluent area. I'd sort of pick an area, and then I would call somebody. I'd call Matt, and I'd say, Matt, who's your broker that uses up-and-comer that you think is solid, that knows that area? And I would get to know that person. I'd take them out for coffee at Starbucks. I'd get to know them, and I would start coveting that area and watching the transactions and start running my numbers and learn. And then once I felt I had enough money to make an offer. I was much more picky when I'm still a picky guy. I just have a lot more experience, so I can get to a decision. But so find my agent. If I'm going to manage it myself, which I probably would, that's what I did. I might take a class at an apartment association so that I understand the rental laws and I understand what that looks like. And I would then start reading up from apartment magazines so that I could then start finding out what the vacancy rates are, things like that, get the data. So I would become an expert. And an expert is just someone who knows more than the average person. And I would start building my team. And my first team member would be one of your team.
I love it, man. Okay, that's good. Now, the exciting part.
Okay.
Right now, you've
Yeah.
been through the downturn. I'm sure you're in a good position. How do you attack or think about moving through this market and not only surviving but thriving?
So, so where Kyle is today, where I am today, as the chairman CEO of a large publicly traded company, my focus is there. Like I work, you know, we had a senior level position, and I do meetings and my hikes on the weekends. So it's like I'm working 7 days a week. That said, being a real estate bug, I know there's gold bug, but let's call it a real estate bug. I love to just, you know, look at data and see things there. I would say I'm trying to see where there are some imbalances in locations that might be interesting. And so there's one opportunity that I'm looking at with some investors that they brought to me that's it's British pound denominated, because the US dollar is doing really well against the British pound, and there's some distressed assets, and there's some very big positive leverage between the cap rate and the debt. So I have some money and I have some friends that have some money, and so I'm not sure. I'm looking at that. I need to get my arms around it because, as you can imagine, if it's British pound denominated, it's outside the United States. And so, and I've invested outside the United States. So I would be very careful, if you have not done that, to make a foray into that today. And then the other one is there's some developers who are going to be building some workforce housing and some law changes. This is in the United States. I'm not trying to drive all your listeners there, so if I sound a little coy.
Yeah, it's okay.
But the developers came to me, and my only hesitation is if everything got passed the way I want. I'm trying to educate those legislators, because I like micro units. We manage some new micro units here in Southern California. They're like 370 square feet, yet they don't feel like it, and they're handicap accessible even in the bathroom. And the kitchen, which is, you're going to go, how do you do it in the kitchen? The kitchen's like a wide hallway. But I love managing for some, you know, that's why I love talking to you, because I love bright people that are in the game, because I learn so much. And so to me, I've already talked to that person and said, look, these folks that want to develop, do you mind if I just take them through your unit? And he said, absolutely not. And I said, look, if there's a place to play, I'll absolutely, I'm not trying to just to use you. I'll ask you if you want to participate as well, because this might be something fun for you. So, and then that iron kind of sharpens the iron. So those are I'm just looking for some ideas that make sense. But the difficult about a new development, Matt, is now we're getting back to, okay, what do you buy the land for? And the interest rates, what does the takeout financing look like? And so right now, if we all of a sudden got the green light from the locals, I think I might still sit and go, I need to feel like we've gotten to the top, you know, because that's a 2-year, 3-year kind of thing. And I can't have the interest rates be 300-400 basis points higher than they are today. And that could happen. And that would wipe out the whole investment. And so, because development is somewhat speculative, that's a tough one, unless the lender will put some sort of guardrails around it, so that caps now what my takeout financing would be. So, so that's the danger in there, is sort of creating the opportunity. But so that's and again, those guys, when they come up with it, it's like, the British pound, the person is investing in our latest round in Glasshouse, and he just, like, at the end of a call, he's like, hey, what do you think of this? What do you think of that? And I'm like, hey, shoot me the deck on that. That sounds really interesting. And then I called him back. I'm like, this seems too good to be true. And so that's kind of where I'm doing the deep dive into it. But so that's what the Kyle of today. But the Kyle of yesterday, and that guy, calling myself in the third person. Please don't write douchebag and put little shit emojis up on Instagram, please, for God's sake. Don't go to my page and just shit all over me for that. I'm gonna stop doing it. But talking to my son and young investors and my teammates here at work, one of my young guys, he's in his 30s. He just paid off some debt and he's about to buy himself a Tesla. I'm like, dude, what? Like, look, I said, I'm not trying to point out the obvious, but I'm a lot older than you, and I make a lot more money than you do. No more shit emojis. Again, I warn you, please. Douchebag alert again. But I said, you're going to buy a nicer car than I have because I want to have money to invest.
Yeah.
What are you doing? Yeah. You don't have any assets. Like, I'm like, hey, come on, man, get some assets. Yeah. I spent I love my team at Glasshouse, and I'm like, yes, you have stock in Glasshouse. Yes, we're working every day for that. But, don't be, either take that money and buy more stock, or I would probably diversify as a teammate because you're already earning. So go get an asset.
Yeah.
So then the question is, do you do it here in Los Angeles or do you do it in Austin, Texas? And I would say, if you don't own an asset and you're here in LA and you're comfortable in the LA story and things like that, I probably wouldn't invest in the city of Los Angeles till we see what happens with the election and the idiots that said the stupid things. You may have seen it, the racist shit. But the problem is, I don't know who replaced them. If it's Democratic Socialists, you got to think about what they may do to your housing, the laws. But I'd invest down in Orange County if I were one of those team members. And if they already own some real estate and they understand it, then I would say Austin that's a market I believe in. Austin, Dallas, and Houston, but I've only invested in Austin.
Got it. I love it, man. Well, I appreciate everything you're saying here. And last thing before we get out of here, put you on the spot a little. Give us a little motivation. Send us out of here with getting a little bit jacked up.
Yeah.
Come on, bring it.
So there's been more millionaires in this country made in real estate investing than anything else. Period. So you're watching the right guy. He's talking about the right subject. He's in a city that's booming, that I think continues to boom. And which is one of the reasons when I was down there, it's like I was down there for cannabis and speaking at South by Southwest. I'm like, Matt, can I meet with you? I want to meet with you. And you're the young Turks that are going to be the next generation of leaders in this industry. You're already leading now, but as people like me sort of like head to the sidelines, it's going to be on you. And so for the folks that are out there, it's invest for tomorrow. Take care of the future you. Tighten your belt a bit. Dress fancy like me. It was like a Columbia Costco shirt. And, focus in on mailbox money in the future. Focus in on, look at how Matt's dressed. That's how you should be dressed when you're retired. And when I say retired, you won't be, because you're going to love doing this and you're going to want to invest more. And once you sort of have a cash flow train, I don't want to take that money and do anything else with it but pay my tax and then take the net and put it back and keep it in that war chest to invest. And I'll tell you what, it's not a bad game. You just got to get that first chip and you got to get over that hurdle. You got to do it. And so it's been the best thing that ever happened to me. I am the accidental real estate investor because I was only doing it for my retirement. And then it's amazing how, if you love doing something, I mean, our conversation, number one, you were nice enough to introduce me to your wife. So like, I was really honored. So I got to see your personal side as well. But I just thoroughly enjoyed that because I love talking about real estate investing. I just think it's, and here's the other thing. Look what you get to do for society. You get to provide quality housing for people. It's their home. It's where they celebrate their holidays. It's where they bring their children home. It's something very special, and it's a relationship that is something that we should be taking very seriously. And someday you can dress like Matt. I mean, look at this guy's cap turned backwards. I don't know why he's wearing a Cleveland cap. That's a whole other subject. He's got it. Look at it. He's got like a t-shirt. He got like a Hawaiian shirt. You could be in Hawaii right now. I mean, and here's the thing. The dude is killing it. I mean, he's a modest guy, but I will tell you, freaking killing. He's a super guy. And because he's chosen real estate, take a look at how he's dressing.
There you have it, baby. The Real Estate Podcast, guys. Thank you for tuning in. Like, comment, subscribe, share with your friends. Buy some real estate. You heard it here. Kyle, thank you so much, man. Really, really appreciate your time, as always.
Matt, my pleasure. Thank you.